So the markets continue to have a little something for everybody, but we've been flirting with market highs and rate lows again, and are really kind of all overboard because there are a lot of cross currents going on. So I want to talk about the mixed messages from the markets and the economy and what our perspective is on it. And these themes are the ones we read about in the paper all the time. The headwinds with supply chain, the ports problem is getting worse, not better. There's concerns about the COVID variants, political dysfunction, and actually even just the inconsistency of where we're going. And then I think this is actually misworded. It shouldn't be the China's policies towards business, but just their general policies, which are having an effect of slowing some of the excesses or reducing some of the excesses in their system, as well as directing the economy towards supporting the things that the party is most interested in, which is social stability and more broader equality, and certainly pushing along the doctrine of President Xi. The tailwinds, though, are really interesting, and I want to cover the jolts versus unemployment numbers. And obviously, the monetary policy support continues to be strong, and as we talked about, even with tapering, it'll continue to go on for some time. The fiscal policy support is actually continuing to pick up, and once they get their acts together and come up with some number, we'll be adding somewhere of a couple $1 trillion of fiscal policy coming, whether it's 1.5 or 3.5, somewhere in between, we'll figure it out. But I think one of the big areas, and it's hardest to quantify, is how the productivity improvements are continuing. But there is a lot of that going on. And then we also have this manufacturing returning to home. A lot of it is a result of the supply chain. From the markets, we have the variant delaying the return to normalcy, pre-COVID activities, and it's slowing down commutation. Ridership on mass transit's down. That's going to take some time to get confidence back. You have the critical shortages, whether it's chips, labor, and materials, as we were talking about earlier. Obviously, labor is the big one that drives inflation for companies. That is going to be one that may be more persistent, but then the chips and materials may be more transitory. But it is certainly on a more persistent build right now. And, we had thought at ARRS that it would be easing somewhat, but it doesn't mean it's not transitory still. It just takes some time for things to work through. Regulatory concerns are a real issue for investors and for the markets, as well as the uncertainty around when we start tapering and what the tax outlook is for companies and for consumers coming out of this, which feel like they're getting a little bit easier, but still a little bit high. On the corporate tax rate, if we go to 26.5%, we are giving countries like China an advantage. The global average is, I think, the OECD nations is around 23.5%. So ideally, you don't want to go over what the global average is because companies react to their incentives or disincentives. So I think that's something we have to keep an eye on. But on the tailwind side, earnings, the low yield rate environment allows for greater borrowing, allows for greater CapEx, which leads to productivity improvements, and that's being supported by strong demand from consumers, companies, and the government. So it sets up a pretty nice backdrop. But there's some really interesting things beneath the surface. So this is a report. The red line is the level of unemployment, not the rate, but the number of people in the it's basically millions. So it's around now just over 8 million. But the blue line is the JOLTS report for job openings for the non-farm payroll. And you're looking at a deficit differential of somewhere around over 2.1 million people. Rarely have we had that kind of big inverse relationship between the two. That does set up a very healthy environment for employees. And then if I just looked at it on the manufacturing sector level, and clearly a smaller sample set, we've carved out a lot of the employment in this area over the last couple decades. It's starting to build back up. But what you can see now is a deficit of between openings and unemployment of just over 350,000 jobs. So there are opportunities to fill jobs. We do have the skills gap that we have to deal with. We had the report today on inflation that came up a little bit lighter than street expectations, but clearly there's a lot that we're seeing, and some of it is more persistent, as we talked about. But there is a big sense that the tech improvements and the CapEx that's being put out will make companies more productive and help them offset some of the rising labor and input costs. And the question that we were talking about before at around 10:30 was, what's the ability of companies to either grow their business without adding a lot of new people because they're much more productive, or to use substitution of technology for labor to offset their increased labor costs. That's really one of the big issues that's going to weigh on what the outlook is for inflation. But you do have a big productivity initiative going on, and CapEx spending globally is going to be up about 13%, over 13% year over year. We are moving back to, by the end of this year, we'll be at about 15% of pre-pandemic levels, and next year we should be getting up to about 120% of pre-pandemic levels, according to Morgan Stanley. And you're looking at big changes. There is a lot of money being put to make the world more productive. And what's interesting is it's going across industries. So whether it's the energy one is one of the lowest ones for CapEx, growing at about 5.5%, but in the healthcare area, the industrial area, those are around 13.6%. Materials looking at a big increase in CapEx, almost 18%. Technology, which has become over half of all CapEx, is growing at about a 22% rate. And another area that should come as no surprise because of the push on climate is the utility sector, which is looking at 16% increases in their CapEx as well. So big changes there. And what's supporting this is the low interest rate environment, which we expect will continue to be a part of the outlook for some time. So that's actually putting a lot of liquidity out there, allowing companies to borrow to invest at very attractive rates. And that has led to a very strong stock market. And we actually haven't had any big pullbacks this year or meaningful. I was expecting earlier in the year that we'd see a 5 to 10%er after the strong year we had last year. But it looks like we're in a consolidation period for the market. But when you step back and just think what's happened over the last decade and how much money the governments have thrown at it, whether it's governments or central banks, we're a world awash in cash. And so for our case at ARRS, we continue to focus on the transformations. This liquidity issue is not going to go away anytime soon. Even if the Fed begins tapering, it's not tightening because they will still be putting new quantitative easing into the system to maybe the tune of, between $500 billion and $800 billion over the next 12 months. Everyone's spending to improve productivity, and consumers are still flush with cash, which gives us a positive outlook for corporate earnings and profits, but not for everybody. There is definitely a big divergence between those who are benefiting in this environment and those who aren't. And this reopening and then the Delta variant has slowed down how that reaction will go. So we're still in equity investing is the best game in town. China is making it a little more difficult for companies that have a big reliance on the Chinese consumer right now. Inflation continues to run hotter than we planned, but we think the productivity increases will be significant. And we think there's a time to stay invested, use dips to add to positions, and be cautious but opportunistic. And Mark, just to give a little heads up on the call that we have today with Ed Yardeni, Dr. Ed's going to be really talking about why he believes the remainder of the decade might turn out to be the roaring 2020s. So he's going to cover a number of topics, including how long the expansion lasts, will inflation be transient or like the 70s? He'll share his outlook for interest rates. One of his thoughts is we might have the mother of all melt-ups instead of the mother of all meltdowns, but a lot of that depends on policy. Will help us with fair value on stocks and I think he'll have an interesting view on monetary theory and also the US versus the rest of the world. So I'll stop there, Mark. Thanks.
That's great.
Hey,
Thanks, Stephen. Go ahead, Mike. Questions?
Rob's not here. I thought I'd jump in with a tax
Oh, he's
question.
here. He's right down the hall here. But go ahead.
Well, he's not on our Zoom.
I know.
Steve, the corporate tax rate, I was just curious if you have insight, like our US corporate tax rate is not what our international global players pay. And so is it really just limited? Is it impact on domestic players only, or, you know, is really the corporate tax rate kind of a bogey? It's not really what anybody pays except, you know, a certain select few that don't have any strategies to reduce that effective rate.
Well, it's never apples to apples when you're going across industries or market caps or geographies, right? So I think it's hard to get a good handle on that. We have, you know, the states are taking their vig too. So it's never really apples to apples, but on a federal level, you have to look at it as that we're going to have a global minimum tax, which may offset some of what you were saying, Michael, about the big companies. But I think we're in a spot where we're going to have slightly higher taxes, and if we push it where they're talking to, it will be less competitive than we should be globally. So I don't think it's going to be as meaningful, and I would say it's actually going to hurt the companies that they least want to hurt more than it'll help. So, because the big ones that you talk about that are good at avoidance will still be good at avoidance. It's the small companies and the small businesses that if you're making over, you know, $400,000 of revenue, you're going to see an increase in taxes, I think, is one of the recent proposals. And between 400 and 500, you're going to be at a level, and then over 5 million, and then over 5 million might be in another one. But we have someone coming up to talk about taxes next, so they'll do a better job on it than I will. I think that might help, Michael. And Mark, back to you, because you have a full agenda.
A lot of what David's doing.
Any other questions for Stephen?
I'm gonna. The call is open. Greg had sent a note asking. I will put try and get the link into the chat room here, and I'll get that done while we're on the call. Thanks.
Any other questions for on this topic or other topics?
No questions, Mark. Who do you have next?
I think people are just waiting for others. They're just being polite. Again, I guess, so Erica, we'll see you in Cleveland. Duncan, we should talk about Michigan. Chris White, get your hotel rooms, flights booked. You know, everything's in our hotel sheets. Last reminder email going out just to see who. Gerald, will see you in Chicago. Joe Azar, I sent you an email yesterday with some names for Greg. You saw that.
Okay. Yeah, I saw that.
Hey, it's Vlad. Looking forward to seeing everybody in Ohio. So,
yeah, we met some more from Ohio here yesterday. We're getting them to come back.
good.
I told them that we got a unique space thanks to you, Vlad, right next to the hotel.
Yeah.
Let's see. Nitu, you want to? I'm waiting for Olga to come. Do you want to just introduce yourself? So we met you in person, but if you're able.
Yeah. Hi, everyone. This is me too. I was able to meet some of the folks, including Mark, in person last Thursday. I'm a GP at Unmatched Ventures, and my colleague Spencer is also on the call. We're looking forward to coming to the tour from the 23rd to the 29th, starting off in Chicago. And Unmatched Ventures is our early stage fund, which is sector agnostic, which we are in the process of launching. I'm also a former early stage investor with Alumni Ventures Group, as well as a founder in the fintech space.
Okay. So we're waiting for Olga Loy. But I'm just going to ping her right now. Any other comments, questions while I do that?
I had one
Mark, if
question,
anyone
Mark.
can't make the call this afternoon, we'll have it on our website posted probably tomorrow, so you can go and listen to the Ardeni call, and I'll get the invite added here in a minute. Trying to find the invite. So.